Welcome to this week's episode of the Vancouver Life Real Estate Podcast and YouTube channel. Lots happening this week, as it seems to every single week in real estate here. We're going to touch on the inflation print that just came in. We are once again talking population growth because new numbers have come out and they are even more eye-watering than the last ones we discussed here. Even with all this population, we need construction, but guess what? Construction costs are skyrocketing, further inhibiting the developers wanting to come to market and setting us up for potential further housing crisis down the road here. Well, what does the government like to do? They love to raise taxes, and there's talk of an increase of upwards of 9% for Vancouver properties coming soon, and we're going to touch on that as well. And then as we're wrapping up the month here, we've got the early data for you in regards to what happened with GVRD real estate in the month of June. We'd love to give you the early insights here so that you can share that and be the knowledgeable expert throughout the Canada Day weekend here. So let's get into the inflation numbers first. As you have likely heard, inflation dropped a full percentage point down to 3.4%. And this is the lowest inflation has been since June of 2021. Apparently, gas prices were the largest driver of the lower print, with gas prices down 18% on average. Of course, we don't seem to feel that here in Vancouver, but apparently nationally, it's down about 18% on average. While that sounds good, there were a lot of metrics that were definitely higher, including groceries registered up 9% year over year. We saw rent rates up 5.7% year over year. I think that's probably modest and lagging. And one of the biggest ones here is that the mortgage interest costs that are part of the CPI inflation basket surged up 30% year over year and remains the largest contributor to the CPI increase. Interestingly, if you were to strip that out, as it's kind of a self-inflicted result of higher interest rates, CPI would be down at 2.5%. But again, let's look at it. And one more metric about that. That would actually be down from 3.7% in April. So 3.4% where we are today. That's getting very close to within the 2 to 3% band that the Bank of Canada is targeting. So with the interest cost, the mortgage interest cost being such a high element, such a large portion of the CPI number, and knowing that if they were to reduce interest rates, that self-inflicted print would actually come lower. Do you think it's time that the Bank of Canada actually lowers rates? Because just a few months ago, they being the Bank of Canada, called for inflation to read sub 3% by June. And by June, I think they mean the June print, which obviously comes in July. And they're only 0.4% away from this actually being achievable. So are we there? Is it time? Can they pull back? Can they pause again? Well, let's keep in mind, while inflation is essentially their main mandate, it's not just a one and done, right? They're going to need a prolonged sub 3% print for them to feel confident in the fact that the higher interest rates have done their job. On the other side of that, of course, they're still dealing with solid GDP growth here. We've got a very robust labor market, and housing prices, again, are up, 6 months in a row here. All of those metrics lead us to believe that, of course, they could continue to hold high rates for longer or even raise again. In fact, the financial markets right now expect that the bank will still increase by another quarter point at their next announcement, which happens on July the 12th. That would bring the overnight rate to 5%. So we're going to keep a very close eye on what happens there. And, place your bids now. I'm going to throw mine out, actually. I'm going to say right now that July 12th is a pause. I don't think they're moving. At this point, it seems like it's anyone's guess. We know the financial markets got it wrong with the last print. With the last announcement where they did hike when they were expected to pause. Now they're saying they're going to hike. And, here we are. It's June 29th when we're recording this. I'm going to throw it out there that my guess for the next announcement is a pause. Brian, what's your take?
Well, we kind of talked about this at length yesterday, but generally speaking, I feel like the Bank of Canada has a tendency to either overcorrect or oversupply. They tend to be in many ways reactive. So I have a feeling that they will actually continue to raise rates only to further cut them at a later time. I just, I have this impression that from the last time when they said, to the economy, hey, listen, we are going to pause here, pause our interest rate hike cycle. We're not sure if, we want to see how the rest of the rate hikes have played into the marketplace. I think a lot of Canadians took that as like, hey, listen, the rate hike cycle's over. Hooray. There was some euphoria. People went right back into housing. Sentiment went right up. People started buying again. And then the Bank of Canada came down and basically slapped everybody on the hand and said, not so fast. So I have this feeling that they're really playing the psychological side of things right now. And I just feel like they want to hammer this out before they will show some signs of relief. So I actually think that they'll maintain the same course. I think they will raise, and I guess we'll see where it goes. But that's my take. Again, like you said, Dan, I think at this point it's anyone's guess too, because they certainly tend to give some kind of forward guidance that they were going to raise or that they aren't going to raise. They didn't do that. It was a surprise rate hike last time, so it's really hard to know what they're going to do. With that being said, let's talk a little bit about population growth. So Canada's population grew by a staggering 1.2 million people in the past year as of Q2. That's in and about 3 times the 10-year average. And in many ways, it's beginning to feel like somewhat of an irresponsible way of trying to pay for the future. The growth in non-PR, right? This is also staggering. This is the four-quarter rolling average, hit 725,000 people. The previous record was under 200,000 people, which is bananas. And you got to think, if you're not a PR, right, the way you get into the housing sector is by renting. So the vast majority of these people are renters. And that is obviously leading to the rental crisis that we find ourselves in. And so, kind of going back to, is this an irresponsible number? It certainly feels like when you look at the States and you look at Canada, just the change in what's happened. I mean, Canada is growing at about 3.5%, especially as of last year. The USA, by comparison, is growing by 0.5%. So we are growing at a staggering rate compared to what is happening in the States and also what's happened historically in Canada. So I feel like if we're going to be bringing in people of this magnitude, I'm not sure we have the infrastructure. We certainly don't have the healthcare professionals. We certainly don't have the teaching, the school system to support the level of people that are coming into the system. And I understand that, this is about taxable revenue so that it can float the economy. But I feel like other parts of the economy are breaking because of the demands that bringing in so many people is going to have. And Dan, what's your perspective on that?
So you'd think that all developers and builders would be rushing to build more homes because there's clearly a demand side for such product here. Having that many people coming into the country at continued record rates obviously means we need to house them somewhere. But what is so inhibiting for builders right now is that essentially, like, the residential construction costs are up as much as 50% in the last 3 years, essentially just before the pandemic. 50%. So that alone is an inhibitor. But then throw on top of that the development lending costs are up about 250% in the last 18 months. So with higher interest rates, it's harder to borrow money at a point where it's going to be profitable for you. Now, we've talked about how much the government taxation comes into effect when it comes to the cost of homes. In and around 25 to 30%, depending whether you're looking in Vancouver or Toronto, for example, but that keeps increasing as well. More and more layers of government taking their pound of flesh continue to accumulate. And now it's upwards of 31% of the cost of a home is going towards the government, money paid to them in taxes and other such levies. 31%, almost a third now. Imagine if the government stepped out and your house was a third of the price less to buy into. Anyway, as a result, of these inhibiting costs, housing starts, people building or starting to build new homes, have fallen to the lowest levels in almost 3 years, dating back to December of 2020. So you take a reduction in new houses being built, you add 1.2 million people into the country in the last 12 months. Is anyone else seeing an issue moving forward here? Building houses is not an overnight process here, right? Homes, depending whether you're building a detached home or a high rise here, including permit times and whatnot, from the moment you decide to build to the moment you hand over the keys, you're looking at almost a minimum of 18 months for, maybe a single family home, duplex, triplex, upwards of 4 to 6 years for a high rise. And yet this problem kind of persists today with the amount of new people coming into the country, and developers are not incentivized to help with that solution. So instead of saying, okay, we're going to make it easier for people to help build homes for all these people we're putting in the country, they being largely the government, saying, look, we're going to make it harder for you to get your building permit. It's going to take longer. And then when you're ready to build, well, we're going to, we're going to add 31% of cost to help build this home. And then of course you have to deal with lending costs and construction costs that are skyrocketing. Not a very attractive means or area or landscape to be in as a developer, right? If you're going to basically not profit from this, why would you move forward? So we're kind of throwing fuel to the fire here, what potentially could be happening with a housing crisis down the road.
Yeah, I mean, if people keep coming into the country and they're going to be going to the major urban centers for work, this is a problem that is going to have another inflection point at some point in the future here. When that largely depends on what the Bank of Canada continues to do, and also what happens with levels of immigration. But generally speaking, if things maintain the course that they're on, it's getting to be more of a mess than anything else. And speaking of a bit of a mess, I just want to touch on the Vancouver property tax, which is scheduled now to be increasing at 9% annually. And this is because the budget for the Vancouver city cannot stay on budget. Like it's almost in dire straits, where they continue to have to increase the tax rate so that they can pay just to stay on budget. And I mean, these are, driven primarily by high inflation. There's upcoming collective bargaining agreements with all their employees, council initiatives like Ken Sim doing a better city, Vancouver's plan to hire 100 additional police officers. These are all kinds of things that are contributing. Now, I mean, as the city grows, they're going to need these things too. So expect as a homeowner that it's going to become more and more expensive to own your home here in Vancouver. And I just hope that the tax dollars that we're paying are really resulting in a better city.
It's obviously much easier to increase taxes than to just hit a budget, apparently. And, we actually talked about this about a year or so ago, where the policies that happened during the pandemic that essentially rose people's property values by about 30%, I said, just wait, the government's going to take their share. And here you're kind of seeing it here in a proposed further property tax increase. So again, if you're paying $400 or $500 extra per year, yeah, it doesn't feel great. But if your home's value has gone up six figures, maybe it's something that people will be okay with if they look at it in that light. Not right or wrong, just a perspective analysis there.
Yeah, assuming it always goes up.
Speaking of where property values are, yeah, right. So let's have a quick look here into what happened in the month of June. As mentioned, we're recording this on June the 29th. So all the data is not fully in, but we have a very good look into essentially where it's going to wash out at the end of the month, and wanted to share this in advance of next week's actual stats podcast. Sales wise here, we're going to hit around 3,100, which is down from last month about 8%, but we are way up from last year, up about 25% in sales volumes. Listings are going to hit around 5,400, which is just slightly down from the previous month and almost exactly where we were a year ago. Inventory today, we've actually cracked 10,000. We're about 10,300. We'll probably end up around 9,500 at the end of the month. And the reason that drops so much is that a lot of listings, when they're taken, tend to expire at the end of whatever month. So you'll see 1,000 or 800 or so listings just kind of disappear overnight. Some will be relisted the following month, some won't. Either way, we cracked the 9,000 mark for the first time in 6 months. So we're actually seeing an uptick in inventory. Now, while that's great, keep in mind we would love and need to see about 15,000 active listings to even start to really enter a consistent, balanced market. Because as of today, well into a seller's market, probably going to wash out around 32%. So anything above 20 is sellers, and we're sitting at 32. So still very, very high and leaning towards the favor of the sellers out there. Price-wise, though, this is the interesting one. So because HPI is a lagging indicator by about 3 months-ish, HPI will all but certainly rise this month for the month of June here. But, and it's a fairly big but here, median has gone down, and so have average prices this month. And this is the first time we've seen those metrics go down in about 6 months. So median is gonna end up down around 15 to 20,000, and average prices are down about 35,000. Being the first time we've seen that in 6 months, it may be an indicator of, again, these increased rates taking further hold. As inventory rises, we can kind of potentially expect prices to go down further if, again, the interest rates stay where they are or increase. And it's not just a Vancouver phenomenon here. We're actually getting some early data from our friends in Toronto who are experiencing a similar downturn this month. So moving forward, I think we're going to see flat to slightly down prices through July and August, where, again, the typical cycle pulls back a lot. Slower sales, slower listings, slower interest, because we have such beautiful summers here. People are focusing on things other than real estate. And with these increased high interest rates, it's just not going to be the number one focus for a lot of people in the coming months.
Especially if they decide to raise rates, they being the Bank of Canada decides to raise rates again throughout the summer. That'll really cool things off, and then make for an interesting September. That being said, every single rate hike that we go through, continues to hurt businesses as well. And we're seeing that in the softening of the commercial and office space throughout Vancouver. In fact, there's a pension fund called Oxford Properties. I believe they're a teacher's pension fund out of Toronto. They actually own a tower, for example, downtown 401 and 402 Dunsmuir Street. It's fully leased out to Amazon. It was built and completed in 2020, and it's now for sale. They're targeting, hopefully, getting somewhere in the range of $350 million for the buildings. With that being said, the reason that they're doing this is because Vancouver's office market, which is historically tighter than much of North America, but the rise in remote work, which has been another compounding issue for this sector, plus the increased borrowing costs, has caused the vacancy rate to climb dramatically, hitting 8.4% in the first 3 months of the year, according to CBRE. In the US, it's even worse. Capital Economics predicted the switch to remote and hybrid work will cause office building values in the country to plunge by 35% by the end of 2025. And these are massive buildings worth a ton of money. So 35% is an enormous number. And the recovery of this cycle, they're predicting, could take up to 15 years. So this is a significant hit from the pandemic that we're only really just starting to realize now. And when you compound it with remote work and you compound it with high borrowing costs, especially putting businesses in tight spots, now, they're not going to break their leases because the penalties are enormous as well, but expect the renewals of these leases to fall right off the map in the next 3 to 5 years.
A very interesting element, and something that you want to pay attention to. And we definitely hear a lot of these business owners that are suffering because of these rates, and understandably, that emulates in the residential space as well. I mean, last episode we talked about how the people that had their 5-year fixed mortgage terms are now renewing. And so, if back in 2018, when the overnight rate was 1.25 and you're renewing today at 4.75 overnight rate, obviously your interest rate, your mortgage rate is going to be much higher. So we wanted to kind of dive a little bit further into that because it's a very serious element here and it's going to dramatically affect a lot of people. And we want to get a bit more specific here with the numbers and, again, some insights into what people should be doing now. So if you bought, let's say you bought a $1 million home in 2018 and you had your 20% down payment and your mortgage rate at that time would have been around 3.4%. So your mortgage payment would have been just under $4,000, 3970 ish. If you have just gone to the bank to renew that mortgage, you're now renewing in the around 6.3, 6.4 fixed term 5-year rate, dramatically higher. This increases that payment to about $49.60, an increase of almost $1,000 per month, around 25% higher payment. That is significant. That's a $12,000 a year swing in just your payments, which again, the predominant amount of that is just going towards interest as well. So OSFI's recently talked to a lot of the banks and said, look, don't let your borrowers wait until renewal to find out how much they owe. They are really stressing that people do whatever it takes now to take action, whether that means increasing your payments, doing a lump sum, or moving into fixed today. Because every single payment, you're essentially getting further behind, and what could happen at the end of that renewal is a bit of a surprise. So if for nothing else today, if you have a mortgage, go talk to your bank today and get a clear understanding of what the outcome can look like if you do nothing from now until renewal compared to if you start making a plan in advance. Because of course, by the time 2026 comes along, again, these 20 to 25% payment increases should be at least expected based on today's rates. We don't know what's going to happen in the next 3 years, obviously. But again, based on today, we want to be proactive, not reactive here. And those on variable rate fixed payment mortgages could see their payments increase by as much as 40% to maintain that original amortization schedule. So if 40% increases are seen, understandably, that's going to be a huge stressor for many. And obviously, that's going to put your money into one place that you wouldn't put elsewhere, like savings or even a little bit of recreational spending, which will obviously pull back on GDP, etc. But again, we kind of harp on this a lot, but it's becoming more and more real because, again, we're now seeing today people after 5 years of a 3-ish mortgage rate, they're now in the 6s. So please take this to heart and talk with your lender about what you can do to stay solvent and not have to stress about this, 2-3 years down the road.
Yeah, some great points there, Dan. I mean, ultimately, at the end of the day, when you start looking at inflation, the fact that the Bank of Canada wants to maintain, higher rates for longer to ensure that inflation stays lower and flushes out, and you add in what's taking place in the commercial and office sector and everyone's renewals and payments going up by 25 to 40%, a lot of this seems to be spelling, it looks like to me an economic slowdown. The only difference here being that we have such massive population growth. And I wonder if, continuing to crank up interest rates is what's going to, it almost unfairly punishes some of the wrong people in this. But that being said, I don't know what other levers they're going to pull in the meantime, but it's certainly looking like a recession is unavoidable in many ways, at least in the immediate future here.
Well, there you have it. So again, as always, be proactive, watch the data, watch the markets, and don't make your house uncomfortable. There are solutions out there. So thanks as always for tuning in. If you're watching this on the release date, happy Canada Day. It's July 1st. Have a wonderful weekend, and we will catch you next week. Thanks.